You maintain that the individual investor can beat the big guys, as you put it. How can that be?
Well, it's pretty interesting from the research we did in the book. Most people know that the typical index funds, the S&P 500 and the Russell 1000, if you invest in those, they beat most managers, roughly about 70% of the managers. And that's pretty powerful. It's because of their low fees and that most managers aren't really adding value. So one logical thing to do would be to say, well, I know only 30% of the managers beat the typical index, so how do I find those guys? And it turns out if you look back over the last 3, 5, and 10 years of those managers' records, there's really no correlation between how they do in the next 3, 5, 10, which is really what you're trying to figure out. So that's why many at least advisors have recommended, and possibly rightly, that index funds for the individual investor who doesn't know how to pick stocks on their own is maybe a good opportunity for most people. So we set out to do something a little better. And as it turns out, the regular indexes, the S&P 500 or the Russell 1000, are seriously flawed, as it turns out. Even though they beat the most active managers, they're still very seriously flawed. And they do something that costs investors about 2% a year. And that really is that they're market cap weighted indexes, which means they put more weight into the larger market caps. And so that if a stock...
Shortchange the losers.
Right. So if you believe like Ben Graham or Warren Buffett that the market's sometimes emotional, it's not efficient like so many professors have professed over many years. It's not efficient. That means that if the market does get emotional over the short term, that some stocks are overpriced and some are underpriced. And a market cap weighted index, if a stock is overpriced, it buys too much of it automatically. And if it's underpriced, it buys too little of it automatically because it's based on market cap, which is essentially price. So it sounds crazy, but it actually is systematically doing the wrong thing at every point whenever there's an inefficiently priced stock. And so there's an easy way to correct that. And there are actually equally weighted indexes. Instead of putting more in the larger market cap companies, it actually puts an equally weight. So if you have the S&P 500, it'll put as much weight in stock number 1 as it will in stock number 500. It still makes plenty of errors. In other words, it's an equally weighting, but those errors are now random, not systematic like a market cap weighted index. So you actually get back the 2% a year. And there are a few people who have come out with something called fundamentally weighted indexes. It's just another way to weight stocks without using price. And therefore, the errors in those indexes are also random, and you get back the 2% from those too. And since we're value investors and have done a lot of research on value investing over a long period of time, we created an index that we call value weighted, which just means the cheaper something is, the more weight we put into it. And it's actually more diversified than the S&P 500 or Russell 1000 index. Has the same volatility, has the same beta, yet over the last 20 years you would earn 7% more a year following that strategy. And it's ridiculously simple. Just put more weight in the cheaper companies.
Before we get to that, you make the point, the reason why there is such opportunity for the individual is that in the investor world, you believe it's become more short-term focused, which means buy high, sell low.
That's a really great point. Big picture is that when you look back at what's happened over the last 20, 30 years, there's been more access to information, there's been more computing power, there's been more people going onto Wall Street, it's high-paid hedge funds and, proliferation of mutual funds and everything else. So there's a lot of smart people actually trying to beat the market, quote unquote. And so you would think that it would be getting tougher and tougher for individual investors to outperform the market. And what it turns out is our simple value factors have actually gotten stronger over the last 20, 30 years. And the reason for that is that the world has become much more institutionalized, meaning, I'll just tell a quick story I tell in the book, which was that in the late 80s I had an investor in my partnership, one of the first fund of funds. And these are funds that actually pick managers, and you're asking them to find their expertise to pick the best managers, and they put that all together in a fund. And so one of the first that was put together in the late 80s, or at least the ones I knew about, asked to invest in our partnership. And at the time I was writing quarterly letters, and that seemed to be fine for my investors. But the fund of funds said, well, we have to report more often, so could you give us monthly returns? So I said, sure, I'll tell you the monthly returns as they come in. And sure enough, after the first month that this fund had money with us, we reported back that we were up 1.1%, which we thought was pretty good. But I got a call from the fund of funds and said, well, you know, we have a lot of other managers that do similar things to you, and the average one of those was up 1.2% last month. To what do you attribute your underperformance? And I politely told the fund of funds to call me back in a year. I probably should have told them to call me back in 4 or 5 years, but I don't think they would have stuck around so long. So I figured I'd settle for 1 year. But the world has become much more institutionalized since then. People look at daily returns, weekly returns, monthly returns. They get analysis over the month or the quarter. It's very hard to keep a long-term horizon when you're investing in the stock market. You know, 4 or 5 years is a more reasonable time frame to judge anyone's performance. And
so you get hyperactivity, which research shows does not lead to better returns.
Exactly. So what happens really is that, you know, if you underperformed in the last 6 months, year, or 2 years, people chase performance. So they take money out of you and put it into someone else. And another statistic I wrote in the book, which I think is the most telling, is if you look at the top performers over the last decade, the top 25% of managers that have outperformed, came up with the best record for the last 10 years, 97%. Okay, 97% of those top managers spent at least 3 years in the bottom half of performance. 79% spent at least 3 years in the bottom quartile of performance. And almost half, 47%, spent at least 3 years in the bottom 10% of performance. So you know all their investors left if they did that. But these are the ones who ended up with the best long-term record. Most people leave them. Most people don't stick around for long enough. One other thing I write up was the top, in the decade of the 2000s, you know, that 10-year period, the top performing mutual fund was up 18% a year. The average investor in that fund lost 11% a year. That was the best one. Why is that? It's because every time the fund underperformed, people left. Every time the market went down, people left. Every time it outperformed, people piled in right after the outperformance. Right after the market went up, people piled in. So with all the investors' market decision, the average investor, the average dollar-weighted investor in that fund over the last decade, the best fund, ended up losing 11% a year.